Okay folks, welcome back. We're going to be talking again about the external range demarker. This is a bearish example, and I want to counsel you to go back and listen to the weekly reviews pertaining to the dollar CAD, because we had been focusing on this pair above the typical fiber and cable trades, and I mentioned we would be looking for a run below this old low here on, what's the date here? February 25th, 2019, attacking the sell side liquidity pool. This day here, this is June 25th, 2019, we have a wick. Okay, we have a wick on this candle as well. This candle goes approximately into the midpoint of this one. I don't have it on here because it's going to create a whole lot of clutter on the chart, but visually you can see it does. On this day, we open, trade up, midpoint of that wick, which is the gap. Okay, it's his external range demarkers within the wick. Okay, we view wicks as gaps. So the consequent encroachment or midpoint of that wick would be here. This candle here is June 25th, 2019. We run the fib on this as well, project that out, and it gives us a specific price range at 31.95.8. And if we look at the mid figure on the fib here, it's 131.95, measuring this previous day's wick. So this day, on the 26th of June, we open at 31.77, we rally to a high of 31.94.4, and we move a distance of 131.06 as a low, closing at 131.22. So essentially, the high here at 131.94 and 4 pipettes, we are expecting a run back to a consequent encroachment to 131.95. Why would we expect that? This candle moves outside of the range of this last up close candle, which was trading back inside of this fair value gap. So all of this in here, okay, this was an original fair value gap, becomes a BISI, buy side imbalance, sell side inefficiency. It's been recalibrated to this low. And again, this is all mentioned in previous recordings, so I'm not kind of like going back in the charts and cherry picking things. You can see this is an amplified view of the things I've already talked about before it happened. But we have a BISI in here, and then we have the consequent encroachment here. Price trades right up in the middle of that, hits it on the 21st of June. So we have a bearish order block here. It sets the stage for any movement back up into this candle once we trade below it, which it does here. So the next day, we're inside of the range opening and trading back up into also the midpoint, essentially, or mean threshold of this bearish order block. So right away, we have a few things overlapping for confluence. 31.95 is our specific price level. Again, that would be targeting a run below the low here, which we'll note at 31.10. Okay, so 131.10. Nice round number. So from 31.95 or thereabouts, or the range of this previous candle on the 25th. So to open at 31.83 up to 31.95. Any price level between those two price points is a high probability short. You're trading inside of power 3, so it's opening, rallying up, and you're getting a fill between 31.95 and 31.83. So it's about a 12 pip window of opportunity. But let's take that information and take it down into a lower time frame, and we'll go into an hourly chart. And this is a naked chart, completely naked. This is the power of this perspective. When you look at price action like this, or if you come into trading as a neophyte, it kind of looks bewildering. You don't know what's going on. You don't have any rhyme or reason as to why things are taking place. Why is it doing? What is it doing? And when we look at things from the scope of the mentorship content, we can bring a whole lot more depth to it. So I'll bring in the information here, and we're going to put our daily dividers in also. This will help delineate between specific days. Now again, the 25th was that day we created that wick. We're trading up into that run up here. We're also taking that range. Now again, I'm going to add a horizontal line and put it on 31.95 even, and I'll walk you through everything that took place here, and you'll see the beautiful precision across the board with all of this. But let's take a jump back before into the previous week. Here's June 20th. Okay, we have a fair value gap residing here. Rejection block, last up close. Okay, and then we have, which is a buy side liquidity pool in the form of a rejection block. Price trades up, creates a wick in here. Trades up into the fair value gap. This activates the fair value gap. This is your institutional order flow entry drill concept for entry. All you need to do is trade back to this high here. That would be a fill. But say you missed it. Okay, you're looking in an hourly chart, and when this candle closes, you can have this range on the wick measured here, and this will give you your specific price point. Now, if I highlight the fib and look at the price point here, it's 32.24.7. So basically 32.25. And the high comes in at 32.24 and 9 pipettes. Okay, so the way you use that is the previous day's body, right in here. The close is 32.20. So 32.20 to a projected consequent encroachment on the wick at 32.24 and 5 pipettes, or basically 24 pipettes. So we only have a range of basically 4 pips. Now the way you can do that is, if we open, as soon as we open and start to trade higher, and you're watching price at the time when it does it, at a kill zone or Asia or London, you can go short immediately as soon as it trades above the previous close, and you want to try to get your fill as close as you can to the consequent encroachment, but don't fancy dance with it a lot, especially when you have such a small little range to work with. Me personally, as soon as we traded above the previous day's close, I would be going short. And because you're using the rejection block here, buy side liquidity pool, and you've already tapped into a fair value gap, so you're most likely going to see price erode and go lower. Then we have price coming back up into it, and before I do that, let's note the elements of the PD array matrix, because it is important. So here's the 50 level. So we are absolutely in a premium market relative to this price swing here to here. Now you're going to ask me, why did you use this swing high, Michael? Doesn't matter, because if I use this swing high here, so all I'm doing is anchoring to swing points. Here's your 50 level. We're still at a premium market. Okay, so don't beat yourself up trying to figure out what's the reason why. I used the most highest one here prior to an up close candle. That's all I did, is a swing high. Now if I take this opportunity here and I go short, I could be targeting these relative equal lows. We have a swing back up in here. Now again, I'm going to measure the fib for the price swing from here down to this low right there. You can see we are in a premium market. Trades up to this price point here. Bearish order block. Price break makes a run lower, breaks lower here, but does not get below here yet. One more time, trades up, and then we start consolidating. Again, this is an hourly chart. We have a buy side liquidity pool here. Equal highs, 2 clean. Last up close candle prior to the move down, the displacement is lower. Institutional order flow is bearish. All premium arrays and bearish order blocks and breakers and such, they are providing resistance. So that's how we know and classify institutional order flow as being bearish. So this bearish order block, we're extending it out in time. We have this run up in here. Now also, this run is trading above 131.95. So 131.95 is being breached here, which is not important yet until the 26th. So that's our important reference just for the 26th of June. So this wick in here, okay, even if we break that down and split it, we have the initial run into the buy side liquidity pool and the bearish order block with this wick. As soon as we get that, if we see price create that wick, we can do the measurement here and get the midpoint, which would be here, exactly at that 31.95 level. So again, we project that out in time. And we also do our standard deviation of the previous wick, doubling that up, and it gives us the exact range high on this next candle. So you can be a seller or going short above this buy side liquidity pool, targeting this level here to this level here. So all of this range in here would be an ideal area to go short. Let's take it 1 degree further in terms of precision. All right, so I'm going to show you with the fib here. So here's where we're measuring. The initial run above the buy side liquidity pool here. Draw your fib down, drop it. Now what I have here is the fib. I'm going to pull this away, keeping on the close. We're running right up into that level. Just fall short of it, moving it manually. In this area here, this is your sweet spot for going short. So you have a range of about almost 10 pips or so. So anywhere in here would be an ideal area to go short. Notice that we have price above on both wicks above the buy side liquidity pool, also trading inside of the bearish order block. Using that as your entry tool or entry technique, you can be short here. If you do not get that, we can resort back to the daily level here that takes you to the 31.95 level using the wicks on the previous day on the 25th. So on the 26th, that 31.95 level that would be our projected high of the day. It also works within the midpoint of this initial wick, as you can see here. So what you would do is you would now use the rejection block. So you have the rejection block, which is the highest up close, and to that 95 level, 31.95. So in this area here, we could be going short. Also, again, basing it on the external range demarker relative to the wicks on the daily chart, and then transferring it to an hourly chart, that 31.95 level, and the previous premium array, which is the rejection block. Notice there's no bearish order block in here, this range. Okay, if we measure the range on here, and again, this is an hourly chart. This is the only lower time frame that I'd like to use it on. Again, here we are trading it back up above the 50 level, which makes this a premium market. And the only premium array you have here prior to running this high out, which we wouldn't be expecting because we've already had 2 scalings of the wick here and then another measurement higher. So we have the previous day on the 25th creating a sell scenario, and then we have that 31.95 level relative to the external range demarker on the daily chart, transferring that to 31.95. So that's our highest price point to the rejection block. There's your range. So in between those 2 price points, again, that high, the close is 31.90. So about 5 pips, less than 5 pips. So how would you use that? You could put a sell order in immediately as price trades above the rejection block, and it keeps everything scaled down, and it's very, very tight in terms of the drawdown that would be associated with the entries and the setups. So the point in all this is there's no real, I guess, magic to using like this long wicked candle here. Just because it's a long wicked candle, you can't say, well, that's a doji or that's a pin bar, so therefore I'm going to be a buyer, based on this, because look what happens. It doesn't do anything for you. Okay, we're using real reference points in IPTA and price delivery to cause a narrative that we'll follow in the marketplace. It's not that we're looking for any old, quote unquote, pin bar, okay, or a doji, and nothing like that. We're not. The premise is not on the individual candle. Okay, the premise is really based on the PD array matrix, and then working with the PD arrays, premium to discount arrays, bullish order blocks, bearish order blocks, bullish breakers, bearish breakers, bullish mitigation blocks, bearish mitigation blocks, fair value gaps, liquidity voids, equilibrium, okay, buy side liquidity pools above an old high, sell side liquidity pools below an old low, bearish rejection blocks, bullish rejection blocks, okay, how they scale out. And again, when we taught you the lesson in the core content relative to the PD array matrix and where those PD arrays are nested inside of a dealing range, that is the order of what you're looking for. Notice there again, there is no fair value gap in this price run here. There is no, once we're trading here, there's no breaker, there's no mitigation block. It's only the rejection block and then what would be above the high, which would be a buy side liquidity pool. But we're not expecting it to trade back above here because we've already seen signatures that it's already created a turning point, and this is just a return right back to the rejection block and right back into the 31.95. Now, if I were to ask everyone, if we were all in a room and I'd say, okay, look, pull up your data and look at the candle on June 26th, okay, at the Asian session, okay, and what was your high on that specific candle? Some of you would probably show 131.95 or a little bit higher, okay, or a little bit lower. It doesn't make a difference. We're not trying to nail it down to the smallest pipette. There's going to be times when it does that, which is remarkable because we're working with retail skewed data. But it's important to know that if we get very close, very, very close to it, and we're able to define a specific price range between a premium array, which is the rejection block here, and a specific price level, a very specific price level, and it's a 5 level, so 31.95. We already talked about the importance of that in the core content. A 0 level or a 5 level, banks are going to want to work with that. So we have a range in here that we could try to get our retail, quote unquote, entry in for our order, just selling it at the market. Now, if this was a little bit longer or wider terms of a range that would permit a limit order, then you can simply do a limit order, above the rejection block. But in here, you may not be offered the opportunity and afforded the luxury of having a limit order because the range that you're working within is too tight. Okay, so I present this with you tonight, and obviously, like I said, we'll be talking more about it. There's a lot to talk about with this signature, and we'll probably spend a month or two working with just this one, and I'll give you more examples and more reasons why you would expect certain things like this to form. But the main thing is, go back and look at the recordings because I had already talked about this occurring, this movement lower into this low here, and we got it. So the weekly analysis for that particular week was we would run the sell side liquidity pool, okay, in here, and then we'd run the lower low to the left of this at a later time. And we'll see if we get that this week or next week for the dollar CAD. Hopefully you found this insightful. We'll talk with you all again next Wednesday. We'll resume our weekly commentary. It'll resume in the midweek, so nothing in terms of analysis. Like I said, I'm at the time of this recording, I'm on vacation still, so I will get back with you all next week on Wednesday, the 10th of July. Until then, I wish you good luck, good trading.